We will discuss all this. And actually, I discussed that also. That suspension of capitalization that are directly attributable to the acquisition, construction, or production of a qualifying asset form part of the cost of that asset. Other borrowing costs are recognized as an expense. Is that clear? I hope I speak English, right? I don't speak Chinese or other language. An entity shall apply this standard in accounting for borrowing cost. Standard does not deal with the actual or imputed cost of equity, including preferred capital not classified as a liability. What is preferred share capital? Now, the capital is divided into two: ordinary share capital and preferred share capital. The preferred share capital is something. You all know what is preferred share capital is?
Opinion.
Express your opinion. Your opinion matters. It is, of course, share capital, but one type. You already have normally what you see share capital in your financial statement is ordinary share capital, meaning the share capital issued by the founders of the organization, and they are the one who will bear all the risk ultimately. It's the ordinary shareholders are like mother at home. What happens? You see, you have this pot of rice or food. In our country, we generally eat rice, so I take the example of rice. What mother does? Mother first serve to father, then to the kids. After then, she will see inside the pot. If anything left over only, she will eat. Yes or no? Yes. But sometimes what happens, unfortunately, major portion of the rice is left. She will eat everything, and then she becomes very fat. That also happens. But on the other hand, if all of them are gone, she had to sleep empty stomach for several nights. I'm just recalling my lifestyle. That time we faced this. A very hard time. My mother, we know that in a week, maybe 3 days town. So he will leave like 100 rupees. I'm talking during 1984, 85, this time. 100 rupees that time, it's big. But yet, he will only come after 5 days or 6 days in that week. So she got to manage this 100 rupees. We are 4 boys. She got to manage with 100 rupees. And many times, she now passed away actually. She slept empty stomach. So that's the sad part of the story. But shareholders, ordinary shareholders, are same to say. They will keep distributing all that to different contributors or different stakeholders, taxman, employees, your suppliers, the purchase cost, supplier, income tax, and the funders like bank. And what is left over only, they will take as dividends. That is left over only, they will take. This is ordinary shareholders. But what do you mean by preferred shareholders? They also considered legally, they also considered to be a shareholder. However, you tell them, look, we need some funds, but we don't need to keep the funds for the next 100 years. We need the fund only for a given project. And this project will last for 5 years. So you give us the money over this next 5 years, we will keep the money and I will agree a percentage of dividend. But for the ordinary shareholders, there is no agreed dividend percentage. Whatever the available remaining profits, based on the AGM, annual general meeting, they will distribute the dividends. But for the preferred shareholders, they will say that, okay, 6%. Then every year you got to pay 6% from the capital what they paid for. This is same like interest.
Loss?
Regardless, company is profit or loss, you committed to them. But for ordinary shareholders, different story. If the company is lost, then we talk about preferred share capital. There are different huge discussion: cumulative, non-cumulative, participative, non-participative, redeemable, non-redeemable. There are so many different classifications. Let's not discuss that here. So that ordinary shareholders and preferred shareholders. So and whatever the preferred share capital not classified as a liability, standard does not deal with the actual or imputed cost of equity. Now I have share capital, and if I say that for that my capital pay me interest. Now if someone is doing partnership business, not a limited liability. Partnership, there is the partnership business are regulated by Partnership Act 1890 Section 2 of UK, and that act says if the partner is contributing capital, you got to pay an interest of 5%. So that argument is not here. An entity is not required to apply the standard to borrowing cost directly attributable to the acquisition, construction, or production of a qualifying asset measured at fair value, for example of biological asset within the scope of IAS 41. So for this we will not apply borrowing cost. Although see, biological asset also can last for more than 1 year. Some biological, like you have a plantation, or you have kettles. According to IAS 41, we will discuss how to treat that. So if you had to incur any borrowing on those, that is not within the scope of IAS 23. Inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. For these two scenarios, IAS 23 is not applicable. Borrowing costs are interest and other costs that an entity incurs in connection with the borrowing of funds. And qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Examples of qualifying assets: inventories, manufacturing plants, power generation facilities, intangible asset, and investment properties. Examples of not qualifying assets: financial assets, inventories that are manufactured over a short period of time. Now, if I go back to this slide, no, this is exactly what this. So, recognition: an entity shall capitalize borrowing cost when it is probable that they will result in future economic benefits to the entity and the cost can be measured reliably. Now that interest you paying for, the interest that you paying for that borrowing relates to qualifying asset, and that qualifying asset will enhance the value. Because of this, you capitalize. An entity shall recognize other borrowing costs as an expense in the period in which it incurs. Any other borrowing cost, not related to qualifying asset, you write off to profit and loss account. Actual borrowing cost incurred on that borrowing during the period, less any investment. I forget about this. Let's say we got the loan on 1 January 2020. We got a loan on 1 January 2020. 1 January 20. And we start the construction on 1 July 2020. So loan 500 million. During these 6 months, no point of keeping the funds for no reason. What I do, I agree with the bank to deposit as a short-term deposit and agree to generate some interest income. Then, when we complete and when I have the borrowing cost, what I need to do, I need to subtract the income I generated on this investment. That will be the net borrowing cost. Income on the temporary investment of those borrowings. I hope it's clear. To the extent that an entity borrows funds generally and uses them for the purpose of obtaining a qualifying asset. What is the key word here? Qualifying asset. Wherever you go with related to IAS 23, remember to look for qualifying asset. The entity shall determine the amount of borrowing cost eligible for capitalization by applying a capitalization rate. Now, what could happen if you have two different loans? One loan at 8%,